Gold and silver mining guru Rick Rule says that precious metals miners now face a positive perfect storm, and that gold and silver is our protection from central bank policies. Let's take a look at his arguments and dive on in. Now, this channel is all about providing global macro insights for informed investing, so do consider subscribing. Now, Rick Rule argues that the context with which miners actually enter this crisis is one of a positive perfect storm, and this breaks down according to each of the following four reasons as I see it. First, in coming into this crisis, miners have faced a real bear market in metals prices over the last 10 years. Rick outlines that this poor price environment has meant that they have largely been starved of capital, while equity has remained incredibly cheap. We can see this awful bear market from precious metals from 2012 through to 2015 in particular. Operating for so long in such a market has ensured that management must lead with absolute efficiency and in a risk-averse manner. Rick argues that this mindset sets up miners perfectly for a period of rising precious metal prices. Secondly, the US dollar has been rising in regard to other mining producing countries' currencies, as we can see here with the Canadian dollar, the Mexican peso, or the Aussie as a few examples. For miners, it means that their costs have fallen in real terms, while the metal price is of course denominated in the global reserve currency. This is an issue we've discussed before and relates to Brent Johnson's thesis on the dollar milkshake theory and a potential super spike of the dollar. While the Fed has been creating new currency, other central banks have also engaged heavily in such tactics. The strong dollar is a net positive for miners. This contributes significantly to the profitability of these mining operations. Third, and perhaps most obviously, is the collapse in the oil price, which Rick states could reduce overall mining costs by up to 50% for some mines. Again, this point will help reinforce stronger margins and mean enhanced earnings reports in coming quarters. Fourth, there's the rise in the price of gold. Rick likes to emphasize that gold and silver don't rise as a result of a crisis. Instead, he argues that they rise as a result of the policy response to the crisis. There's a number of key reasons for this, which I think we can break down to the 3 Ds. That is currency debasement, what Rick refers to as counterfeiting by central banks, escalating deficits, and the acceleration of national debts. But there's also the artificially low interest rates placed upon savers. This thereby reduces the opportunity cost of gold and silver as savings yield no or potentially even negative interest. What's more is we know that we have only just begun to see the start of the policy response, with the Fed's balance sheet currently at $6.53 trillion. Macro guru Raoul Pal has pointed out that while the US has seen a rollout of $6 trillion fiscal and QE-based programs, losses are far greater in the aggregate demand. In fact, he believes that around $20 trillion has been wiped off US equity and credit values as a result of the February and March crashes. A 50% market recovery may allow for a $10 trillion loss. Add this to the $2 trillion loss in economic output from quarter one and allow at least another $2 trillion write down for quarter two. That means that so far the Treasury and Fed intervention only papers over the cracks of lost demand. Everyone is keenly aware that more stimulus is going to be needed. Every analyst and economist anticipates rapid further increases of the Fed's balance sheet, irrespective of whichever way the stock market actually moves. This is so bullish for gold and silver prices and helps reinforce miners' profits. And then there's the fiscal policy response, which could actually reach as much as a deficit of 20 to 25% of GDP. Absolutely enormous figures. Thus, Rick is predicting an enormously bullish outlook for precious metals producers and has no fear of future prospects of nationalisation of these miners as potential strategic industries. He argues that while governments have largely been able to actually convince savers that their hard-earned cash is being devalued for their own good, it means that there's no reason to actually undergo forced nationalisation programs. Most market participants participants are expecting sharp pullbacks to the stock market in coming months. So what could potentially happen to miner shares in such an environment? Well, of course, it's tough to say, but if falls are significant, then there may be some forced liquidations. Mining stocks have already seen such collapses in February and March. A repeat of this scenario may see mining stocks fall once again. However, the obvious counter-argument is that miners will, in the autumn, be about to release earnings reports which reflect the higher metal prices and the lower oil costs. Indeed, equities tend to rise well after metal prices increase. This is a direct consequence of the fact that it takes time for company earnings reports to come through, which then reflect these higher gold prices and significant cost advantages. This will then strengthen income statements and balance sheets, and in Rick's eyes, bring great gains to shareholders. Let's just check some data on this. In 2008, miner shares fell, as we can see here, yet thereafter the prices began to rise while the stock market continued to decline. Meanwhile, gold prices reached their all-time high in dollar terms on the 5th of September 2011. Yet we can see Franco-Nevada shares in particular peaked in September of the following year. And something I found very interesting is how the mining shares of many firms performed so well during the market collapses of 1929 to 1933. Here we can see that Homestake mining faced a liquidation point in 1929. Thereafter, the shares were off to the races. This was while gold remained fixed at $20 under the gold standard. The confiscation and revaluation of gold in 1933 helped send these shares soaring. Nevertheless, there clearly remains the risk of further liquidations if there are significant stock market declines. Now, Rick has also referred to some firms that he considers top companies which really are worth considering in a portfolio, which include Franco-Nevada, Barrick, Wheaton, Precious Metals and Agnico Eagle. And as for an exit strategy, well, Rick proposes looking at softer indicators such as when you see himself or other experts on TV discussing mining equities, mining stocks more generally. That's the time to sell, he argues. Now, thanks so much for watching, and if you want to understand why gold has such potential upside, do check out this playlist. Or alternatively, to know what to look for and when the gold price will truly pop, do see this video. Please like, share and subscribe, and I'll look forward to seeing you next time. Bye bye.